Friends, this is Mangai, Associate Professor from Tirthakalnadar College. Today we are going to learn about dividend policies in financial management. As we all know, the term finance is the lifeblood of a business, and the primary objective of financial management is to maximize the market value of the equity shares. Here, we might have a question like, what is the relationship between dividend policy and market price of the equity shares? Before we deal with this, let us understand the term dividend. Dividends are the payments made by a company to its shareholders. It is a portion of the corporate profits which is paid to the stockholders or the shareholders of the company. When a company earns a profit or surplus earned, that money can be put to two uses. It can either be reinvested in the business, which is called as retained earnings, or let it be paid as a shareholders to the shareholders as dividends. The definition is, according to Weston and Brigham, dividend policy determines the division of earnings between payments to the shareholders and the retained earnings. Now, what is called as a retained earnings? Retained earnings refers to that part of the corporate's net profit after tax which is not distributed to the shareholders as dividend, but it is reinvested in the business. A higher dividend means the lesser will be the retained earnings. Thus, the dividend policy of a company must strike a balance between the distribution of the profit and the retention of the profit. There are different types of dividends offered to the shareholders of a firm. Now let us see the types of the dividend. They are cash dividend, scrip dividend, bond dividend, stock dividend, property dividend, and liquidating dividend, etc. There are conflicting opinions regarding the impact of the dividend decisions on the value of the firm. The dividend theories are broadly classified into two groups. One is the theories of relevance, which is associated with the Walters model and Gordon model, and the second one is the theory of irrelevance, which is associated with hypothesis model. Theories which consider the dividend decision to be irrelevant, that is, this theory considers the dividend decision has no effect on the wealth of the shareholders or the prices of the shares, and hence it is irrelevant so far as the valuation of the firm is concerned. And the second one is the theories which consider the dividend decision to be relevant, that is, under Walters model and Gordon model, they consider that the dividend decision to be an active variable influencing the value of the firm. Now, under the theory of relevance, let us see the Walters model. According to Walters model given by Professor James F. Walter, the dividends are relevant and have a bearing on the firm's share prices. Walters model shows the clear relationship between the internal rate of return, that is small r, that is rate of return on investment, and the cost of capital K. The choice of an appropriate dividend policy affects the overall value of the firm. In determining the significance of the dividend policy, Walter holds that the relationship between the firm's internal rate of return R and the cost of capital K is very crucial. Let us see the Walters formula to determine the market price per share. P is equal to D plus R by K into E minus D by K, where D is the dividend and it is calculated as earnings per share E into payout ratio, and K represents the cost of capital and small r represents the rate of return, and capital E represents the EPS, earnings per share. Hence, he classified the firms as growth firm, declining firm, and the normal firm. For a growth firm, the rate of return or the internal rate of return R is always greater than K, then the firm should retain all the earnings, that is, the retention ratio should be 100% and the payout ratio will be 0%. And for a declining firm, R is lesser than K so that the shareholders can make higher earnings by investing elsewhere. Thus, Walter has related the dividend policy with the investment opportunities of the firm. Where a firm has ample investment opportunities, that is, promising higher rate of return than the cost of capital, then it should retain all its earnings. Hence, it is declared as a growth firm. Whereas, if a firm lacks in such investment opportunities and assures the rate of return higher than the cost of capital, then it should distribute its earnings, that is 100 percentage. Hence it is considered as a declining firm. The last category, where the internal rate of return R equals the cost of capital K, then the shareholders are indifferent between the retention amount and the distribution of earnings. Thus, Walter has related dividend policy with investment opportunities of the firm. Now let us see the assumptions of Walter model. All the financing is done only through the retained earnings. There is no external financing is used. That is, there is no debenture values. The rate of return R and the cost of capital K remains constant irrespective of any changes in the investments. All the earnings that is earned by a company are either retained or distributed completely among the shareholders. The EPS, that is the earnings per share, and the DPS, dividend per share, remains constant. The firm has a perpetual life also. This Walter model also has its own criticisms. There is no external financing, hence that the investment policy or the dividend policy or the both will be below the standards, and the Walters model is only applicable to all the equity firms. So it is assumed that the rate of return R is always constant, but however it decreases with the more investments. It is also assumed that the cost of capital K remains constant. Hence, the cost of capital K is equal to the cost of equity capital KE, because there is no external source of financing is used. And next, let us see about the Gordon's model. Gordon's theory on dividend policy is one of the theories believing in the relevance of dividends concept. It is also called as the bird in the hand theory, that states that the current dividend are very important in determining the value of the firm. Let us see the Gordon's formula. According to the Gordon's model, the market price of the share is equal to the present value of the future stream of dividends. Hence, the market price per share P is equal to D divided by K minus G, or E into 1 minus B divided by K minus BR, where P is the market price per share, D is the dividend per share, and it is calculated by EPS into payout ratio. K is equal to cost of capital, G is equal to growth rate, which is again calculated by B into R, where B is equal to retention ratio and R is equal to rate of return. And Gordon's model has its assumptions. There is no debt, there is no external financing, and the internal rate of return remains constant, and the cost of capital K also remains constant. It has a perpetual earnings. As it has a constant retention ratio, this model assumes a constant B value once it is decided by the company. Since the growth rate G is equal to B into R, the growth rate is also constant by this logic. K is always greater than G. That is, Gordon's model assumes that the cost of capital K is greater than the growth rate G. This is important for obtaining the meaningful value of the company's share. Now let us see the next theories of irrelevance, which is associated with the Modigliani-Milner hypothesis model. The dividend irrelevance theory states that the investors may affect the cash flow regardless of a company's dividend policy. If a particular investor considers the dividend is too high, the surplus will be used to buy the additional company stock. If an investor considers the dividend is too low, it will sell some portion of its stock to replicate the expected dividend. So, according to them, the dividend decision is irrelevant and it does not affect the market value of the equity shares because the increase in wealth of the shareholders resulting from the dividend payments will be offset subsequently when additional share capital is raised. If the additional share capital is raised in order to meet the funds requirement, it will dilute the existing share capital and which will reduce the share value to the original position. Now, the basic assumptions of the Modigliani Miller theories are the capital markets are perfect and there are neither a flotation nor a transaction cost and no corporate taxes. The capital structure does not affect the cost. That is, the cost of the capital remains constant at any proportion of the debt and equity. Both the management of the companies and the investors have equal access to all the public and private information. That is, there is no arbitrage opportunity. The cost of equity is constant at any dividend payout ratio. The dividend policy hence does not affect the capital budgeting. The market price under the Modigliani Miller model is determined as it is based on the assumption of same discount rate or the rate of return applicable to all the stocks, where the market price of the share at the end of the period P1 is determined PO, that is the market price of the share at the beginning of the period, into 1 plus KE, cost of equity capital, minus dividend received at the end of the period T. So, under this hypothesis model, the computation of the number of new shares is derived as the investment requirement of a firm can be financed by either the retained earnings or by the issue of the new shares or both. So, hence the number of new shares to the issue is determined as the investment proposal has to be determined first, then the net income of the firm less dividend distribution, and the resultant answer will be the retained earnings available for the investment. Now, the new shares to be issued for the balance amount, that is the investment proposal minus the retained earnings, is derived. As soon as it is derived, the number of new shares is determined as the amount to be raised by the issue of the new shares divided by the issue price per share. Here we will get the number of new shares. The Modigliani Miller model has its own criticisms as this dividend policy suffers the following limitations. The perfect capital market does not exist. The taxes are present in the capital market. According to this theory, there is no difference between the internal and external financing. This theory believes that the shareholders' wealth is not affected by the dividends. However, there are transaction costs associated with the selling of shares to make the cash inflows. So, this makes the investors prefer the dividends. The assumption of no uncertainty is unrealistic. The dividends are relevant under the certain conditions as well. Thank you.